Hi, everybody, and welcome to a fresh, new Made for YouTube episode. I'm Sumaira Abidi, and today we're going to be talking about how to create wealth via mid-cap funds, both in the active and the passive management space. Joining in, we have Raghav Iyengar, who's the Chief Business Officer at Axis AMC. Hi, Raghav. Thanks for indulging us so often. My
Thank you.
first
Thank you.
question,
Thank you.
my first question, because we're talking about mid caps, is that large caps is a mainstay in a person's portfolio. Small caps, we're seeing that the last year has been phenomenal. Probably the rally will continue. Where does mid cap fund figure in this equation?
So yeah, as the name suggests, Sumaira, it's right in the middle. That's a no-brainer. It's mid-cap, right? So, if you were to look at what the mid-cap universe is, it is company number 101 to 250. If you were to see in the top 500 companies. So it's actually, and these are companies with market cap of between 10,000 and about 30,000. And they trade, the average traded volume in this space is about 16, 17,000 crores is the average market cap of a company. So it's actually smack right down in the middle if you were to look at it. Large caps are anybody over 30,000. And of course, you have the giants, which are at 100,000 plus, and small caps are anybody less than 10,000, where again the average is about 4, 5,000. Now, these are in some sense really high growth companies because they've made that transition from a small cap, from a concept, from a promoter led entity to now really trying to compete with the big boys. So in some sense, these guys have made that transition. They've gone past that. I call it the existential jump. And if you look at how these companies have done, especially in the last 7, 8 years, if you look at the top 50 mid cap companies, they've generally beaten both the broad indexes, which is the Nifty 500, and if you look at they've even beaten the Nifty 50. So to my mind, a mid-cap fund has to be an integral, important part of your portfolio. You cannot avoid it. It has to be there.
No, fair enough, Raghav. But the thing with large caps is that they offer security, stability. The small caps are offering way more alpha. Now, with mid caps, the thing is
Yeah.
that while they have some stability of the large caps, they also have some risk like the small cap. So, how does a person
Yes.
choose
Yes.
then which is the better mid cap fund? Because if you go for small cap, you're assuming that okay, I have a very high risk appetite, and so I will take that bet. But for mid caps, the
Absolutely.
assessment of a fund becomes even more important, right? In that sense. So, how
Yes.
does a person
Absolutely.
choose?
Absolutely. I think critically, you have to see. There are various styles, as you know, Sumera, in the market today. Various fund houses have their own different way of looking at stocks. I think, to my mind, the two big things that one should see, one someone should look in their portfolios. How is the style, and is it based on quality, and is it based on growth? Because essentially, mid cap company is higher growth as compared to a large cap. But unfortunately, it is a high risk space. It's not as high risk as small cap, but yes, it is reasonably high risk. So we did a small analysis over the last 10 years. If you take the entire set of 150 mid-cap companies, less than 10% have actually graduated from becoming a mid-cap to a large cap, which is what you would hope your investments will become. In fact, more than 20% have actually flipped back down into becoming small caps, so where they have actually become wealth destroyers. So I think the way to analyze a mid-cap fund is not to see how that fund has done in a market rally, but more importantly, to try and see how he has done in a market fall. And then obviously look at it over a period of time, maybe 5 years or something, which will give you a good track record to see whether how the fund has done at various market periods. So it's like in a year like 2021, it is much, much easier to make money in a mid cap space. Practically every mid cap fund has given Nifty plus kind of returns in their portfolio. So obviously the investor, if he's looking at a 1 year time frame, will just go blindly into mid caps, but maybe that's not the right approach. So I would say if the way I would personally look at my investment is like, hey, how is this guy done? More importantly, in a fall and rather than in a rise, and more importantly, then how is the style of the investment? Is it focusing on quality? Is it focusing on growth? What are the liquidity of those stocks? And those are all easily available in public domain. It's not that the stuff I'm talking about is not something which is difficult to get.
Okay, so for someone who's looking at a long term time horizon, would now be a good time to allocate towards mid cap or even perhaps increase the allocation?
I think that's a very one-on-one question because I would not know what the investor's risk appetite is. But anyone who can put some money away with a 5 year time of a horizon minimum, and doesn't need to churn his portfolio too much, I think is a great definition of a good mid-cap investor. So I think you should, in fact, in the mid-cap space, you should actually stay the course. I mean, I have seen investors in our funds in Axis who've been there since the inception of the fund, and they've had a very good investment experience. The problem which happens in this business or in this scheme, especially Sumaira, is that people look at the last 1 year, 2 year returns jump in, and then obviously if you've had a very spectacular year like you had in 2021, maybe the next 6 9 months your investment may not do that well, which is possibly what is playing out today, right? And then they get a little disappointed because they've come with that high expectation, and then they tend to jump up. So actually, that's not the right approach to have. In some sense, this is the classic. I mean, I say this for all equity funds, but it really applies to mid cap funds. Is the fill it, shut it, forget it definition. I mean, if you put in as much as you want, as much as you can afford to keep for a 5 year basis, you should be in a position to stomach some volatility because that's the nature of the scheme, and you should have a reasonably long time horizon, at least 5 year plus. And then I think the investment journey is, to my mind, will be very good.
So we've spoken about the importance of the mid-cap funds, Raghav. Now to decide between whether you should choose an active strategy or a passive strategy. Now, for a country like India, where stock picking is still so important, especially in the mid and small cap space, would active funds be the right way to do it, or is passive funds now becoming an option as well?
I think passives, it's like, Sumaira, you cracked it on the head by saying it's an and option, it's not an or option. So I think you need a combination of active and passive, obviously, in your portfolio. Again, your contention is absolutely right. India is a beautiful stock pickers market. I think there's a lot of value addition by active research. But I think the key thing is that how is it's ultimately investor choice. So if you're able to get into a good, well-constructed index like the Midcap 50, which takes into account the liquidity, the quality, the management issues, maybe that's a good way to start building your experience in a mid-cap fund. And as and when you get a little more comfortable with the volatility, with the way the fund is managed, then you could possibly graduate into a actively managed fund. Alternatively, I think there are many funds in the market which have excellent track records on a 5 year, 10 year basis. I think you should look if you have the time and the energy, you should have a look at that and see how they have done. As I said in the past question, how have they done in times when the market has not done well? And then obviously, if you get comfort, then you pick your strategy at that time. But as I said, I mean, going back to your first question, you cannot avoid make mid cap funds in your portfolio your if your goal is to make wealth, especially over the long term through equities.
But Raghav, for an investor, and I'm assuming that this is a high risk investor who's looking at a mid cap fund, what would be the key risks that they should know about?
I think the biggest risk is the quality of the company in which you're investing. So, like I said, we did that study and we found that more than 25% of the companies are actually have had seen market valuations go below mid cap. And that is a function of poor governance. You will notice that in the stock. If you see very obscenely high promoter holdings, massive movements in the stock price for no rhyme or reason, a lot of social media activity around the stock, things like that, then I think that's the time one investor should be a little careful. So as I said, this is a great category to make money, and a lot of people buy mid cap stocks directly. So I think, to my mind, I think that's a little, unless you are really a full-time market professional, I think that's a little dangerous approach to have because I think you should ideally go to a professional fund manager. I think, like I said, at Axis, I think the two things that we really focus on is quality of the company, long-term sustainable growth. And I think if we get these two right, and then everything else gets married into it. So the other big risk, which is not there in, let's say, a large cap fund, is liquidity of the stock. Because I think if you get stuck in a stock, even if you make a mistake, it's very difficult sometimes in the mid cap space to just exit your mistake. And or you exit at a very high price, which is called the impact cost. So again, the other way to look at it is what's the non-promoter holding? Is this widely held among institutions? What's the daily float of that stock? Now, these are again variables which are available. I mean, if you go to your own website, you'll find all this information available. For someone like me who's a bit inherently lazy and who doesn't want to take that trouble to do it, I would rather pay my little bit of fees and entrust it to an active fund manager or a passive fund manager, depending on my choice of investments at that time.
Okay, Raghav, just one final question. for somebody who already has funds in their portfolio, like even a large cap fund will have some allocation to mid cap, a flexi cap fund will have some allocation to mid cap, multi cap for sure. So therefore, do you require a specific mid cap fund over here? And secondly, would SIP be the best way to do it? Do you recommend maybe more frequent SIPs because it's a mid cap fund?
I would go with that. Answering your second question first, I think SIPs are a wonderful way to invest in equities overall, but specifically for mid and small cap, I think they're a great way to build your corpus in a slow, steady manner without worrying about where the market is. Yes, coming to your first question, I think it's again investor based. If the investor is reasonably clear as to how much he or she wants to put in a mid cap sector, I think then obviously you should go to a mid cap fund. If the investor is saying that I don't care about how much, I mean, let the fund manager take that choice, then obviously he or she can go to a multi cap or a flexi cap fund and then obviously manage that. Large cap funds, to my mind, Sumera, have very not that high allocations to mid cap because of the nature of the product. I mean, large cap funds, as you know, more steady, more long. They are so they will not take too much of risk, especially where volatility is concerned. So yes, if you're not clear about how much money you want to put in mid cap, then yes, a flexi cap or a multi cap is a great option for you. Especially the new multi cap series are great because they do mandate a certain minimum amount of 25% of the fund has to be in mid cap, 25 has to be in small cap, and 25 has to be in large cap, and the balance can be in any of the three. So you're effectively handing over that choice of yours to the fund manager. But there are many investors, and I'm sure you get a lot of them watching your show. Thanks to people like you sort of educated them. They are very clear that out of my 100 rupees, I don't want more than 5, 8, 10, 12% going to a mid cap fund. Then obviously, yes, you can opt for a mix of mid cap passive and obviously active mid cap funds, both.
So basically, for everybody who's watching, the answer to pretty much every kind of question that an investor has lies in your own asset allocation. We can talk about
Yes.
any category of funds, but ultimately it boils down to the investor having to sit down and decide what is it that they're looking for, what is the goal that they have in mind, and therefore decipher which is the best way to sort of try and reach that. All we can do is just explain what is out there, but the ultimate decision lies with the investor. And I urge, therefore, every investor to sit down and do this due diligence on their own. It'll go a long way in bolstering
Absolutely.
their portfolio. Raghav, as always, thank you very, very much for joining
So
in
much, Sumera.
and
Thank
for
you.
talking about the mid-cap segment. So with that, we're going to wind up this episode. Stay safe, everybody. I hope this has been useful.